Hi, this is Shubhriyo, and the Monetary Policy Committee meeting got over today. So there were big changes done to the LAF. There were big changes announced in the CRR, and there was a big push towards credit growth as well. So this was a very interesting Monetary Policy Committee meeting, even though the rates were not cut. So let's dive down and see what the changes were exactly. So let's begin with the resolution of the MPC. So this resolution document, it lays down what the main changes were. So the first thing that you need to understand is that status quo was maintained. So this means that the rates were not changed, and interestingly, the MPC committee members, the 6 members, they usually vote for the changes or not to change. So all the 6 people voted to not change any rates. So right now the policy repo rate under the LAF, it has been kept unchanged at 5.15%. So there is no change. It is the same as it was earlier. And the reverse repo rate under the LAF, this also remains unchanged at 4.9%, and the MSF and the bank rate both stand at 5.4%. So as you know, we have a 25 basis point monetary policy corridor, and 5.4% is the top end of that corridor and 4.9% is the bottom end. So it remains unchanged and there are no changes for these things. And the MPC also said that the stance which is quite very important for the MPC, the stance remains the same, which is an accommodative stance, as it is necessary to revive growth. And they also said that their broad-based goals for inflation targeting, they will be the same. So 4% with a band of plus minus 2%. So nothing changes regarding those things which were already there. And now coming to the global economy. So the MPC mentioned that the global economic activity has remained slow paced, and they also said that the advanced economies are not doing so well. However, the US economy, it grew by 2.1% in Q4 of 2019, and it's the same pace as of Q3. And in the euro area, the economic activity had slowed down a little bit. So rest of the things that they mentioned over here are not so important to understand. However, you must remember one very important thing, that the governor himself mentioned that the Chinese economy had slowed down to a 29-year low of 6.1% in 2019. So as you know that the Chinese economy is facing a huge slowdown, and now with the coronavirus, they have also mentioned that it's going to be even tougher in the coming days. And the reason for the 29-year-old year low growth is the sluggish domestic demand and prolonged trade tensions. So as you know, the US and China trade tensions are simmering for a long amount of time, and this has actually caused a lot of issues to their economy. And so the next thing is regarding the crude oil prices and the gold prices. So both of them shot up in early January, sparked by the US-Iran confrontation, but they softened from mid-January as geopolitical tensions eased. So by the end of January, crude oil prices dipped sharply due to sell-offs triggered by the outbreak of coronavirus. So coronavirus is becoming a very important economic factor in all of the calculations regarding growth, and it is impacting even the demand for oil as well, and gold of course. And so the gold prices have inched upwards because of some safe haven demand. And they also mentioned that inflation has edged up in some major advanced economies and emerging market economies. So the inflation has been rising across the world. And the another thing that the RBI mentioned here is that the equity markets have rallied across AEs and EMEs, the advanced economies and the emerging markets, and they have turned bearish towards end January with the outbreak of coronavirus. Again, this is being mentioned. So the markets have been bracing for the impact of these things. And they also mentioned regarding bond yields, which had hardened in the US towards the end of 2019 as investors turn to riskier assets. So you already know that hardening of bond yields means that the yields are rising, which is not good for the economy, as we already discussed in a previous video. I'll put the link up top so you can see. And so they have softened in January 2020, which means that the bond prices have come under control, and especially of the US Fed left the policy rate unchanged and assured the extension of repo operations. So because of certain operations of the US Fed, this has actually transpired like this. So moving on to the next part of the speech, So the next thing that they mentioned is regarding the NSO growth estimates, and this is very important because India's real GDP growth for 2019 to 20 has come at 5%. So it's very low. As you know, it's a historic low. Since a long time we have not reached so low growth rates. And in its January 31st release, the NSO also revised downwards the real GDP growth for 2018-19 to 6.1% from 6.8%, which was made earlier. And they also mentioned that the GVA, the real GVA growth, is estimated at 4.9% in 2019-20 as compared with 6% in 2018-19. So as you understand, the economy is going through a tough time, and the growth rates have been falling, and the GVA has also been falling for a long time. So now we will go to the governor's statement that was also released by the RBI, and there we can understand what the governor had been talking about and what were the major implications and the major decisions that were taken by RBI in this policy meet. Let's move. So this is the governor's statement of the monetary policy statement that they release. And as you see over here, the governor mentioned that the MPC has voted unanimously to keep the policy rate unchanged. So the policy rate, it has been kept unchanged. And as I told you, 6 people, all the 6 members of the MPC, they have voted towards this decision. So there were no opposing decisions. And the stance, which is also very important, is the accommodative stance. So the RBI is saying that this accommodative stance will remain as long as necessary to revive growth while ensuring that inflation remains within the target. So this is quite important. And now we move on to the next important thing. So there are a lot of things mentioned in this policy document. It's not important for you to go through all of these things. I'll just pick up the important points and tell you. So you have to remember those things. So make sure that you note them down. And so as we already talked about that, the India's real GDP growth estimate for 2019 to 20, it's at 5%. And as we understand that both key pointers of investment activity, which are production and imports of capital goods, which are the high frequency indicators, both of them continue to contract in November and December. So government expenditure, especially of the center, is providing counter cyclical support to domestic demand. So this means that government expenditure, that is what is actually helping our economy at this point of time, because private investment, private expenditure is not so good because there's not a lot of money in private hands. So the government spending is actually driving our economy at this point of time. And the RBI also told about the supply side things. So about the supply side, you can see that the Rabi sowing has been higher by 9.5% up to January 31st 2020 compared with a year ago. So this Rabi sowing, since it is higher, now we can understand that inflation might be contained in the coming months because the sowing has been on a higher side. And they also mentioned that the industrial activity improved in November after contracting in the previous 3 months, and the output of core industries returned to positive territory in December after 4 months of contraction. And the another thing is that the capacity utilization in the manufacturing sector, this has actually fallen even on a seasonally adjusted basis. So these are few important things that you need to remember, and I'll soon be going down to the important points. So those are the very important changes that I talked about at the beginning of this video about the CRR and the LAF. So let's move on to the next section. So this is all about the retail inflation. So the retail inflation, as I already talked about, that it had surged to 7.4% in December, which is the highest reading since July 2014. So inflation is quite high, and as you know that our MPC target is 4% plus minus 2%. So we have a range. The high range is 6% and the low range is 2%. So as you can understand, 7.4% means that they are not able to manage this. And the food inflation, it has actually risen to double digits, which is quite concerning. And the RBI said that it is primarily caused by a spike in onion prices due to unseasonal rains in October, November. So what they also mentioned is that if you exclude onions, the headline inflation would have been 5.2%. So the high prices of onions, and as you know, there have been countless memes on that in social media. So the onion prices have been shooting up for a long amount of time. Right now they have stabilized a little bit, and so things will be looking good in the coming months. And the inflation in CPI, excluding excluding food and fuel or core inflation, continued to edge up from its October trough. So that's a very interesting and good development. And the net foreign direct investment, this is also a good number for our economy. It rose to 24.4 billion US dollars in April to November of 2019 from to 21.2 billion dollars a year ago. So we have had a lot of FDI coming in, and the net FPI investment was of the order of 8.6 billion dollars in 2019-20, which was up to February 4th, the estimates, as against net outflows of 14.2 billion dollars in the same period of last year. So as you can understand that FPI and FDI both we have received in a very high amount, and this is actually quite good for our economy, for the growth prospects. And moving on to the CPI projections, so this is just an important projection that the RBI always makes in its MPC meeting, and the CPI inflation projection has been made upwards to 6.5% for the fourth quarter of the financial year 2019-20, and it is 5.4 to 5% for half yearly one estimates, the first half of 2020-21, and 3.2% for quarter 3 of 2020 to 21, with risks broadly balanced. And it also projected GDP growth for 2020 to 21 at 6%, in the range of 5.5 to 6% in the first half of the year, and 6.2% in quarter 3. So as you can understand that MPC also noted that inflation has surged above the upper tolerance band around the target in December 2019, and they are also saying that in the coming weeks and months, onion prices are likely to ebb as the supply conditions will improve. And so the MPC is actually remaining quite vigilant, but they are hopeful that this will be corrected in the coming days. So moving on to the next part of the governor's speech. So he said that the transmission of the policy rate reductions, it has been sizable across various money and bond markets. It's important to remember this number, that this number, which is that the policy repo rate since February 2009, it has fallen by 135 basis points, and I have already told you about these things. So because of that the ultimately the transmission was not actually happening, and the RBI is saying that the transmission to the credit market is gradually improving, and the 1 year MCLR, it has actually declined by 55 basis points from February 19 and January 2020, and the weighted average lending rate WALR, this is basically the fresh rupee loans that have been created by the banks. So this has actually also declined by 69 basis points, and on the outstanding rupee loans, it has declined by very less, by 13 basis points. So as you can understand, the repo rate was cut for 135 basis points, but as you can see, the transmission is quite less even now. So the RBI is thinking about various reforms so that the transmission can be bettered over the coming months and the years. And this is something about the transmission. And the important thing is that the external benchmarking system, which was introduced from October 1 of 2019, it has strengthened monetary transmission quite a lot. So this is quite important to remember. And you also have to remember that underlying the decline in GDP growth in 2019-20, it's a deceleration in private consumption, stagnation in investment, and contraction in both exports and imports under the impact of the slowdown in global growth and trade. So basically, these are the reasons for which we have a decline in the GDP growth. And the pickup in GDP growth in 2020-21, which the RBI hopes will happen, it is going to be led by private consumption. And this is because the RBI thinks that there have been quite a few reductions in GST rates, and income tax rate reductions are also there for the middle income slabs, and this will actually help them a lot. And the RBI is hopeful that private consumption, it will improve going forward. And so the next part of the speech, it's not, these things are not that important. You need to remember that the downside risks to global growth, they have increased quite a lot due to the outbreak of coronavirus. So what they are saying is that the coronavirus, it might be impacting global growth to a huge extent, because as you know, China has been affected. All of the provinces of China have been affected, and I'll make a video on coronavirus very soon so that you can understand it further. And the next important thing, and this is very important, is the revised liquidity framework. So this revised framework is quite important because the RBI, they had set up an internal working group which was reviewing the LAF things, that whether the LAF that we have right now is good or bad. So now they found out that the overnight LAF, the overnight repo and reverse repo, these are not important at all. So this is a huge change. The RBI is basically saying that the overnight range, they are going to do away with. So as they mentioned, the framework is simplified by doing away with targeted provisions linked to NDTL, net demand and time liabilities. Multiple operations for multiple tenors would be replaced by one fortnightly operation at the beginning of the reporting fortnight, following by fine-tuning operations every day as required. So this is very, very important, and perhaps one of the most important things of this MPC meet. They are saying that the overnight reverse repo, these are going to be just stopped. So right now, what is the implication of this? What happens is, because the bank used to park their excess funds with the RBI, right? So they used to park it with the RBI so that they would not lose a high amount of money as interest foregone. So they used to park it with the RBI, but right now they cannot do that. So what they have to do, they have to go for the 15-day, the one fortnightly operation that is being talked about. So that high amount, the high tenor variable term repo is going to be chosen by them. So if they don't want to do that, so what they can do, this is actually a loss for the banks, right? Because they could easily keep the money with the RBI, the excess money, but now since they cannot do it, they might have to go and invest in government bonds. So they will not get a good return on that also. So what is going to be happening because of these things? Because of these things, the banks will go ahead and lend more. So this is the entire implication. So because they are doing away with the overnight things, the bank will feel, okay, I do not have a place to park my excess money, let me go ahead and lend it. So I will get at least a good amount if I lend the money. So the banks will not be hoarding the cash, they will go ahead and release it into the economy. So that's the thinking that the RBI is just gathering towards, and they are going after it. And they also mentioned that the corridor system is going to remain unchanged. So this is also very important, because the monetary policy corridor, as you know, the 25 basis point corridor that we now have, that remains unchanged. So the LF is not changed for those things. And the next important thing is the long-term repo operations, the LTRO. So this is something that is quite new. So what are they saying in LTRO? In LTRO, they are saying that we are assuring banks about the availability of durable liquidity. So durable liquidity is the amount of liquidity which persists. So the term repos of 1 year and 3 year tenors in appropriate sizes for up to a total of 1 lakh crore from the fortnight beginning on February 15, 2020 will be given to the banks at the policy rate. So what does this mean? This basically means that the RBI, they are telling the banks, okay, we will lend you cheap credit just on the repo rate, the 5.15% that you have. We will be lending you that money on that rate for 1 year and 3 year tenors. So what is this going to do? This is going to encourage the banks that, okay, we have a source of funds, we will not be having any liquidity crunch. And this is to just tell the banks that, okay, since we are going to lend it to you, it will be very useful for you to go ahead and lend the money. You do not have to think about liquidity mismatches, and since you are getting so much money at such a cheap rate, you don't need to worry about it at all. So what this is going to do, we talked about this a little bit in the yield curve video. So what they are trying to do is that the short-term bond yields, which were a little bit high recently, so they will also come down, because the banks will understand that, okay, since I am getting this cheap loan from the RBI itself, why do I need to go ahead and buy those bonds? It's not important. So the yields will actually come down, and they will actually match with the 5.15% 5%. So by doing this, RBI is calibrating. So this is also a yield curve calibrating kind of thing by just releasing term repos of such high tenors into the market for 1 lakh crore. Yeah, it is only for 1 lakh crore. So this is actually not that much of a big amount, but at least the banks can go ahead and take some. So this is all about that thing. And the next thing we come to is the bank credit to specific productive sectors. So this is also very important, which is that scheduled commercial banks, they will be allowed to deduct some amount from the CRR. So CRR is always maintained, the cash reserve ratio, it's always maintained on a fortnightly basis. So because it is maintained on a fortnightly basis, what the RBI said, that they will allow the banks to deduct the equivalent of incremental credit disbursed by them as retail loans for automobiles, resident housing, and loans to micro, small, and medium enterprises over and above the outstanding level of credit to these segments as at the end of the fortnight ending on January 31st, 2020 from their net demand and time liabilities for maintenance of cash reserve ratio, CRR. So what does this mean? This means that if in that reporting fortnight, because CRR is always fortnightly, so in that fortnight, if the bank gives three types of loans, one is housing loan, second is car loans, automobiles, and the third is MSME loans. So if the bank will give these three kinds of loans, then that incremental amount, the amount that they gave in that fortnight, they can use that amount and deduct it from the CRR. So they do not need to keep that 4% CRR. 4% minus the amount that they have accumulated by giving these loans. So you can just deduct a portion of the CRR if you are lending. So what is this telling the banks? It is telling them that if you are going to be lending a lot of money, then you do not need to keep so much CRR. So this is a very positive thing, a very positive push to all of these banks. And this scheme is going to run till July 31st of 2020. So I think the RBI did this because they are thinking about this on an experimental basis. Because remember, nothing like a CRR cut has ever been done like recently, and they want to tread carefully on this, because this is as good as a CRR cut, because you are just going to tell the banks, okay, if you're going and giving these loans to these three sectors, we are letting you minus some amount of CRR. So this is huge actually, and they want it on an experimental basis till July 31st of 2020. So moving on to the next thing. So this is about the external benchmarking of new floating rate loans. So as you know, there were external benchmarks for the retail loans and the housing, the floating rate loans as well. So right now, the MSME loans, they will also be benchmarked to the external benchmarks, and the pricing of loans by SCBs for medium enterprises is also being linked to an external benchmark effective April 1, 2020. And the next important thing is the one-time restructuring scheme for MSME advances. Now remember that this MSME advances restructuring thing was actually announced in the budget, and Nirmala Sitharaman had said what? She had said that we are going to ask RBI to allow this. So RBI has now allowed this. What has it allowed? It has allowed one-time restructuring to GST registered MSME accounts that were in default but standard as on January 1, 2020. So if they have become standard as on January 1, 2020, we are going to allow them to restructure their accounts so that they can pay off a little bit less amount of loan or with reduced interest rates. And this restructuring under this scheme has been implemented latest by December 31st, 2020. So this restructuring scheme is open till December 31st of 2020. And another important thing which you must remember for exams is that the theme of this year's Financial Literacy Week that happens at RBI every year, it has been selected as micro, small and medium enterprises, MSMEs. So that's the Financial Literacy Week theme, and it will be observed from February 10 to February 14, 2020. And the final thing that we come to, it's basically regarding the commercial real estate sector. So in the commercial real estate sector, it's not that very important. So you can just read it, that the date of commencement of commercial operations of project loans for commercial real estate, if they are delayed by reasons beyond the control of promoters, they will be delayed by 1 year without downgrading the asset classification in line. So if the project has been delayed for reasons beyond the control of promoters, they can get another 1 year leeway without downgrading the asset classification. So they will be kept as standard assets for 1 more year. So this is all about the little bit of NPA classification. And the next thing is regarding the RRBs, which are going to be allowed as per other commercial banks to act as merchant acquiring banks using Aadhaar Pay. So BMAP and POS terminals, they are going to be allowed to use those things. And the next thing is regarding the all the rupee IRD transactions. So these are the rupee interest rate derivatives markets, and there is a push that these related entities and the transactions of market makers, they will be globally accounted for in India. So this means that it will encourage non-resident participation. So NRIs will be participating in the interest rate derivatives market. So it's a push to this market. And another important thing is the netting of financial transactions, which were proposed in Union Budget 2020-21. So what happens in advanced economies is that when there are multi-party transactions, they can go ahead and net those financial transactions, and only the net amount has to be paid. So in India, we did not have proper guidelines for these things. This is all regarding the derivatives market, netting of derivatives market. And so for that, directions are being issued regarding exchange of variation margin for non-centrally cleared derivatives by the end of March 2020. So this is a bit technical, and if you are working in any derivatives sector, then you need to understand this, but it's not important for the other general people, because the netting of financial transactions, this has been actually given by the ISDA, the International Standards for the Derivatives Association. They are actually dealing with these things, and they had actually written a letter to RBI requesting that the netting transactions should be allowed in India, and RBI has gone ahead and helped them, has listened to them. So read about it if it's pertaining to your sector. And the final thing is the payment and settlement system things. So the measures in PSS, they are going to be introduced. So three important measures are going to be introduced. One is the construction and dissemination of a composite digital payments index to capture the extent of digitization of payments. So this index, it will allow us to understand how much of the payments are being digitized. So it is going to give us a metric. And second is a framework for a self-regulatory organization for orderly operations of the entities in the digital payment system. So SRO is going to be set up in the payments and settlement system. This is actually a big news, because SRO means entity which is going to be self-regulatory. So for example, the ICAI, which regulates all the CS in India, that ICAI is a self-regulatory organization. So the RBI is thinking that a framework for an SRO in the digital payment space is going to be set up. And the final thing is that expanding the reach of CTS, or check truncation system, pan-India. So CTS has been introduced a long time ago. There were some pockets which were devoid of that. So they are going to roll it out across pan-India. And this is all about the MPC meeting. So this was actually the final MPC meeting of the financial year 2019-20, and incidentally it was also the first MPC meeting of this year, of this calendar year 2020. So I hope that you enjoyed it, and I hope it was very informative. Please like this video if you enjoyed it, and do subscribe for more videos like this, and I'll see you in the next one. Bye bye.